Hi, I'm Elena Tanzola and I welcome back Mickey Falk from Mercenary Geologist and Rod Husband from Cipher Research. In this video series, we're discussing how to pick the right gold explorers and developers. Mickey, Rod, what are some of the challenges investors are facing in this sector?
Well, I think the real challenge is there are so many companies out there, and bear in mind they all have a story and they're all claiming to be the best because they want your speculative dollars. So what we need to do is eliminate the many pretenders from the few contenders quickly.
Yeah. And in that light, as we learned from our review of the gold mining companies, another challenge is that reported information is not always the real story.
And when truth be told, these beginning explorers don't really have any tangible value until they make a discovery, develop a deposit, and table a resource. Until then, it's purely speculative value based on the geology, the geologist, geological team, the jurisdiction, and of course the management.
Yeah, and what happens in bear markets is companies that do actually have a resource get dragged down with the ones that do not. So there's an opportunity for tremendous value at those times. And that's really what we have out there today, is the ability to find a company with a valuation usually reserved for companies in the pre-resource stage that already have a proven quality resource.
The problem for most investors is they don't have the time or the level of expertise to do thorough due diligence, so they're dependent on experts, and those experts need to be completely aligned with the investor's own interest and not on a self-serving agenda. For example, generating a brokerage commission, or perhaps an institutional analyst whose management has set an artificial target price. But of course we're all biased and we're all talking our own books. I mean, I am, but what you've got to do is fully disclose your bias and develop the trust and confidence of the investor. And so for me, if I make good stock picks at the right time and reward my subscribers who choose to follow my lead, then we're all happy, we all make a profit.
So Mickey and Rod, you've both been in the industry for a long time and you have been successful in picking the right stocks. How do you do that?
Many experts will tell you that the most important asset for a company is management, but we've yet to see any company taken over for its management team. It always comes down to its asset. So at Cipher, we take a value investing approach. We believe that the market will ultimately value quality assets fairly. In bear markets or in bull markets, you can make money with quality assets. So what we do is we take a very detailed evaluation approach to the asset using our proven technique of geonomics.
Mickey, is your approach similar?
Well, it's similar in the fact that I use a peer evaluation, but I don't do a detailed financial analysis. The first thing I would do would be look at the company, once again, to eliminate the many pretenders. So I'll look at the share structure, the people, the project, cash in hand, or especially in a bear market, the ability to raise cash without severe dilution. Once I've got a group of companies, then I go to the deposit being key. And so I'll look at the grade tonnage, I'll look at the geology, the type of deposit, the geopolitical jurisdiction, and finally the market cap. Once I get the number of ounces, then I take the market cap, develop $1 per ounce in the ground, and if that is much less than peer companies are valued, then that becomes a speculative buy for me. And bear in mind, I'm a trader and not a buy and hold guy.
Thank you, Mickey. So you both agree project is king and not all deposits are created equal. So what constitutes a quality project? As far as I'm concerned, that is a very complicated task to determine.
Yeah, the task itself is complicated, but the equation is relatively simple. Value equals quantity times price. So at Cipher, we start with determining what the price of gold in the ground should be. So as this first chart shows, we evaluated 253 takeovers that have occurred in the industry between 1990 and today. And as this chart shows, most of those transactions have occurred below $100 an ounce. And in recent years, when gold shot up, there's only a slight correlation of the price paid per ounce to the price of gold. As the second chart shows, in fact, over 80% of the transaction have occurred below $90 an ounce. So $90 becomes our benchmark price. The third slide here shows that, in fact, the size doesn't really matter either. $90 an ounce is paid for the smallest takeovers and the largest takeovers, but the vast majority anyway.
And Mickey, your approach?
Well, certainly Cipher's benchmark of $90 an ounce is a legitimate upper limit for me. So what I would do would be to take data like that and look for companies that are severely undervalued. Now I have to say that an exit strategy only being a takeover is not really viable with my business model. What I'm looking for is undervalue. So once we find an undervalued stock, then we would buy it and we would wait until it became valued with respect to its peers, whatever that number might be. And like I said before, I'm a trader, so my modus operandi for trading is something I call the power of two. That's the trading philosophy. And it demands that when a stock doubles, I sell half and I take that money and try to find another one that will double. But essentially what I've done is taken all my money off the table. So then I'm playing with house money, other people's money, or perhaps I'm even playing with your money at that point of time. And then we would program sell on both the uptick and downtick, so we're continually taking profits after we've taken our money off the table.
Thank you, Mickey. So it sounds like you both have similar approaches in valuation based on peer comparison. We'll get into more details on that in our next video. Mickey and Rod, thank you once again for sharing your thoughts.